You drive for Uber. You also drive for Lyft. You also deliver for DoorDash. Maybe all three in a single shift. You are making more money than you would on one platform alone. But when tax season hits, you are staring at a pile of 1099s, thousands of miles in your tracking app, and one uncomfortable question: how do I file all of this without messing it up or leaving money on the table? This video is not a basic Uber tax guide or a DoorDash walkthrough. We have those on the channel already. This is specifically for multi-app drivers, the people running 2 or 3 platforms at the same time who face a unique set of tax and income challenges that single platform drivers never deal with. Welcome to the Freelancer's Wealth Blueprint. We help freelancers, gig workers, and self-employed professionals understand taxes, build savings, and stop leaving money on the table. If that sounds useful to you, subscribe and hit the bell. Let's start with the biggest question multi-app drivers have. What happens with mileage when multiple apps are running at the same time? Here is the rule. You can only deduct a mile once. If you are sitting in a parking lot with Uber, Lyft, and DoorDash all open and waiting for a ping, you are driving 0 miles. No deduction. The moment you accept a ride on Uber and start driving to the pickup, those miles are deductible. You drove them for business. But you cannot also count those same miles for Lyft or DoorDash, even if those apps were technically open on your phone at the same time. This sounds simple, but it gets complicated fast. You accept a DoorDash delivery. While you are heading to the restaurant, a Lyft ride comes in that starts right near the drop-off. You finish the DoorDash delivery and immediately pick up the Lyft passenger. Every mile you drove was a business mile, but each mile only counts once. You do not get to double or triple count them because multiple apps were involved. The 2026 IRS standard mileage rate is 72.5 cents per mile. At that rate, 15,000 business miles gives you $10,175 in deductions. That is significant. But the key is accurate tracking, not inflated tracking. The IRS requires a contemporaneous log showing the date, the destination, the business purpose, and the miles driven. If you are audited and your mileage log shows more business miles than your odometer can account for, you have a serious problem. This is exactly why your mileage tracking app matters more as a multi-app driver than it does for someone on a single platform. Apps like Everlance, Solo, and TripLog are built for gig workers running multiple platforms. They automatically detect when you are driving and classify trips. Solo even links directly to your gig accounts to match trips to specific platforms. The point is this: use one app to track all your miles across all platforms. Do not use separate trackers for each platform. One app, one continuous log, one set of miles. That is what keeps you clean in an audit. Now, let's talk about the 1099 situation. As a multi-app driver, you may receive multiple 1099 forms from multiple companies. Uber might send you a 1099-K for ride and delivery payments and a separate 1099 NEC for bonuses and referral payments. Lyft sends its own 1099s. DoorDash sends its own. You could easily end up with 4, 5, or 6 different 1099 forms for a single tax year. Here is what matters. Each platform reports only what it paid you. There is no overlap between them. Uber does not know what Lyft paid you, and Lyft does not know what DoorDash paid you. So there is no risk of double counting on the income side, as long as you simply report what each form says. For 2026, the 1099 NEC threshold is $2,000 under the One Big Beautiful Bill Act, up from $600. The 1099-K threshold remains $20,000 with at least 200 transactions. Here is the critical point for multi-app drivers. If you earned $1,500 on Lyft and $1,800 on DoorDash, neither platform hits the $2,000 threshold for a 1099 NEC. You might not receive a single form, but you still owe taxes on all $3,300. The IRS expects you to report every dollar of gig income, forms or no forms. Download your annual earnings summaries from each platform's driver dashboard and use those to file accurately. When it comes to filing, you report all of your gig driving income on Schedule C. You have 2 options. You can file one Schedule C that combines all your rideshare and delivery income together, or you can file a separate Schedule C for each platform. Most tax professionals recommend one combined Schedule C for drivers doing the same type of work across multiple platforms. It is simpler, and your deductions, especially mileage, apply to the business as a whole, not to individual platforms. Your total business expenses, mileage, phone, car washes, phone mounts, supplies, and any other deductible costs come off your combined income. The net profit from Schedule C flows to your 1040 and is also subject to self-employment tax at 15.3%. Eligible drivers can also claim the QBI deduction, which is 20% of qualified business income and is now permanent under the One Big Beautiful Bill Act. Now let's talk strategy. The real advantage of multi-apping is not just accepting more rides. It is using time blocking to maximize your hourly earnings. Time blocking means you analyze which platform pays best during specific hours and in specific zones, and you prioritize accordingly. Here is how experienced multi-app drivers do it. Morning rush, 6 to 9 a.m., rideshare demand is high. Uber and Lyft surge pricing kicks in. You prioritize rides? Midday, 11 a.m. to 1 p.m., lunch delivery demand spikes. DoorDash and Uber Eats pay better than rides during this window. You switch to delivery. Afternoon, 2 to 5 p.m., demand drops on all platforms. You run all three apps simultaneously and cherry-pick only the high-value orders. Evening, 5 to 9 p.m., dinner deliveries and evening rides both surge. You toggle between rideshare and delivery based on real-time demand. The drivers who earn 20 to 30% more than single app drivers are not working more hours. They are working the same hours more strategically by letting the highest-paying platform win each time slot. From a tax perspective, time blocking also simplifies your mileage log because your trips are more intentional and easier to categorize. Random driving with 3 apps open hoping for pings creates messy logs. Structured time blocks create clean, defensible records. Here is your action plan. Use one mileage tracking app across all platforms. Download your earnings summary from every platform at year-end. File one combined. Schedule C for all gig driving income. Never count a mile more than once, even if multiple apps were active. Set aside 25 to 30% of your net earnings for taxes. Pay quarterly if you expect to owe $1,000 or more. And build your weekly schedule around time-blocked platform switching, not random multi-apping. Multi-apping is one of the best income strategies in the gig economy. But it only works long-term if your tax game is as organized as your driving game. Get both right, and you keep significantly more of what you earn. Subscribe for more guides built for gig workers running real businesses. See you in the next one. This content is for educational purposes only and does not constitute tax advice. Consult a qualified tax professional for guidance specific to your situation.